Have you ever wondered about the invisible rules that protect your money? I mean, they're working constantly, every second of every day, and most of us never give them a second thought. Okay, so picture this. You tap your card for coffee, you click buy now online, or maybe you send a friend some money. The money zips out of your account, and then what? What really happens in that split second? There's this incredible invisible architecture making sure it all gets to the right place, safely. So yeah, let's dive into that. The best way to get your head around this is to imagine a massive, invisible financial highway. It's the superhighway that all of our money, every single transaction, travels on. Now, the official fancy term for this highway is a payment system. And according to the Bank for International Settlements, it's way more than just tech. It's this whole mix of instruments, procedures, and, this is the key part, the rules of the road that control how money moves between everyone in the system. Honestly, that financial superhighway analogy, it's perfect because we're talking about trillions of dollars racing through these channels every single day. These systems are, and I mean this literally, the bedrock of our entire modern economy. They make everything possible, from you buying a coffee to a giant multinational corporation making a trade. But what happens if there's a crash on that superhighway? A big one. This is where we get into something that genuinely keeps central bankers awake at night. It's called systemic risk. Think of systemic risk like a financial virus. It's this terrifying possibility that if one big player can't pay its bills, it could start a chain reaction. Suddenly, other banks, even totally healthy ones, start to fall, one after another, until the whole financial system is at risk of collapsing. So, how does that virus spread? Well, it all starts with just one participant failing to pay up. But see, that's not just their problem anymore. Because now, everyone who was expecting money from them doesn't get it. And if they don't get paid, they can't pay their own bills. You can see how fast this spirals out of control into a massive crisis. Right. And we're not talking about some quiet country road here. We're talking about systems that are officially called systemically important. A failure in one of these isn't like a little fender bender. No, it's a 20-car pileup in rush hour that brings the entire global economic highway to a grinding halt. Okay, so you've got this huge, scary, potential problem. How on earth do you stop those dominoes from ever tipping over in the first place? Well, the answer is you write a global safety rulebook. And the group that stepped up to write this rulebook is the Bank for International Settlements, or the BIS. The easiest way to think of them is like the central bank for central banks. They're the neutral, grown-up in the room where all these global financial standards get hammered out. There's a line in their report that just nails the whole mission. They say it's all about strengthening the financial infrastructure before there's a problem. So this isn't about reacting to a crisis. It's about being proactive and building a system strong enough to prevent one from ever happening. So what was their big solution? It's a set of guidelines called the core principles. Basically, it's a universal rulebook, a set of 10 golden rules designed to make these financial highways everywhere safer and more efficient, whether you're in New York, Tokyo, or anywhere else. Okay, so what are these rules, really? How do they actually work? We can boil it all down to 3 main pillars of stability. Pillar number 1 is all about building a rock-solid foundation. First, the rules have to have legal teeth. They need to be enforceable. The money that's actually used to settle payments has to be super safe, ideally money from a central bank. And then, the obvious stuff. The whole system needs to be secure, reliable, and run by people who are transparent about what they're doing. These are the absolute basics, the non-negotiables. All right, pillar number 2, smart risk management. This is huge. It means everyone involved has to understand the risks they're taking. They need clear step-by-step plans for what to do when things get messy. Payments have to be settled quickly, at the very least by the end of the day. But here's the real kicker, the big one. The system has to be built to withstand its single largest member going bankrupt. It's like having a built-in stress test running all the time. And finally, pillar 3. This one makes sure the system is actually useful for the real world. I mean, it's great if it's safe, but it also has to be efficient and practical. And this part's critical. It can't be some exclusive members-only club. The rules to get in have to be fair, open, and public for everyone. That's how you get competition and a system that really works. You can actually see these principles at work in how these systems are built. There are basically 2 main flavors. The first is called real-time gross settlement, or RTGS. Think of it as paying for everything one by one instantly. It's incredibly safe because there's no waiting around for money. The downside? It takes a ton of cash or liquidity to keep it running smoothly. Then you have deferred net settlement, or DNS. This is more like running a tab and settling up at the end of the day. It's way more efficient with cash, but it creates that risky time gap where someone could go bust before they pay. What the core principles do is give us a rule book for managing the risks of both of these designs. So, okay, we've got this great rule book. But who's the ref? Who's blowing the whistle if someone breaks the rules? That's where central banks come in. They basically have 4 main jobs on their checklist. 1, they have to be open and honest about their own goals and policies. 2, if they operate a payment system themselves, they have to play by the exact same rules, no special treatment. 3, they have to act as the watchdog for all the systems they don't operate. And 4, they have to work with other central banks around the world because these systems are all connected. So yeah, the big takeaway is that central banks are the referees. It's not enough to just have a rulebook on a shelf. They're out on the field every day, making sure everyone plays fair, and, most importantly, keeping the entire game safe for all of us. And that brings us right back to the beginning. This whole invisible world of rules and referees, it's not just some abstract thing for bankers to worry about. It is a vital safety net. It's the only thing standing between the smooth global economy we rely on and a total financial meltdown. It's what's protecting your money right now, every single day. But of course, the world never stops changing, right? We're heading into a future of instant digital payments, crypto, and all kinds of new tech we haven't even dreamed of yet. So the big question we have to ask ourselves is, how are these safety rules, these core principles, going to have to change and adapt to keep us safe in a future that we are literally building as we speak?